Well, good afternoon, everybody. Thank you for the introduction, and thank you all for joining. I'm going to give you a very quick overview of who we are and what we do, and of course, how it's going. And then I'm keen to get to the Q&A as quickly as possible and keen to hear what's on your guys' mind. So I'll start by explaining who we are and what we do. So if you go a couple slides ahead to the summary that explains what Beforepay is. So we are a mission-driven organization, and that's a really important part of who we are. So we exist in order to give customers a safe and affordable way of managing through times when they might be financially overstretched and they need to borrow a little bit of money for a short period of time. We do that with what we call a pay advance, which is essentially a small loan of a few $100s. Last year, the average loan size was about $360. And just for a short period of time, it's 3 or 4 weeks. It's just a tide me over product until you get paid next time. The idea is that it's not a revolving loan. So unlike putting something on a credit card, you don't find yourself paying interest and then finding yourself potentially in a debt spiral and ending up in a difficult situation. And it's priced far more affordably than traditional products from the financial services industry. We are explicitly designed to destroy payday lending and predatory lending as an institution with something that is a lot more ethical and affordable for customers. We're not a buy now, pay later. I can see how the name would create that confusion, but we work directly with our customers to make these small advances. It's entirely digital, so it's all done on the app. It takes 5 to 10 minutes to sign up the first time. Subsequent loans, if you do pay yours off and come back again for another one, will take a minute or less on average. And the way that we manage that risk exposure is through a very data-driven analytic process. When you join as a customer, with your consent, we link up to your bank account. We look at the transactions in there, and we calculate, even in the space of a few seconds, several hundred different attributes about you, looking at your income, looking at how you spend your money, looking at behavioral finance things that we can see in that data as well. So that's what the product is. It really is that short-term tide me over wage advance product, and it's designed to help people who may not have a lot of savings get through a short-term cash flow issue without finding themselves paying a lot of money for it or potentially ending up in a difficult position through some kind of debt spiral and compounding interest. We charge a fee of 5%. There are no late fees, again, no compound interest, nothing else to pay. So it's one of the very few products like this where if you borrow money, you know exactly what it's going to cost you. If you borrow $200, that is a $10 cost to you, and that number will not change. Customers are very loyal to the product. We have tremendous customer reviews and advocacy. We find that if somebody uses the product and they successfully repay us, which you need to do to remain eligible, the odds that they have at some point, whether a month or a year later, come back for an additional advance down the road, that's more than 95%. So once customers have tried this product, they genuinely see that as a better way of getting through those temporary cash flow challenges, and they virtually never go back to what they were using before. Now, if you turn to the next slide, you'll see some of the highlights from the annual results that we just put out for FY23. And the short answer is all the numbers are very much moving in the right direction. So you can see here that the default rate, that net transaction loss, that was 2.1%, which we offset against that 5% fee that we charge. As a result, our unit economics are very good at 1.9% of the amount advanced. That's almost doubled year on year. In FY23, we crossed over the $1 billion mark in cumulative advances. And again, at that sort of small average size of $300 to $400, that's obviously millions and millions of advances. We crossed over 1 million registered users. And you can see that for a fintech, we have actually made tremendous progress towards profitability. In FY22, our EBITDA loss was $19.5 million. Last year it was $3.1 million. So the cash burn has come right down, and we have a very strong financial position. We had more than $20 million of cash on the balance sheet as of the end of June. We have no head company debt. We have some receivables financing, but there's no debt attached to the corporate entity as a whole. And so the progress has been really, really strong over the course of last year, and we're feeling pretty confident about the future. The next slide has more detail on some of the financial results. I'm not going to go through that in any detail. These slides are all drawn from our annual results presentation, which you can find on our website, beforepay.com.au, or on the ASX. But as you can see, and as you'll see on the charts that follow, we're pretty comfortable that the numbers are all moving in the right direction. And I think we really are starting to separate ourselves from the pack of other fintechs and startups in terms of that progress towards profitability, keeping a fast rate of growth. Revenue is up 101% last year, while also getting attractive unit economics and, again, moving towards that break-even position. If you go to the next slide, you'll then see that we think about two numbers as we look at our financial results. The one on the bottom is what we call our net transaction margin, and that's a kind of gross contribution figure. That shows the revenue that we earn, less the defaults and the variable costs associated with issuing those advances, things like the cost of the payments in and out. And you can see that over the last four halves, that's come up from $400,000 to $6.6 million in the second half of FY23. So that's a measure of both growth and our unit economics. And you can see that number is coming up really nicely. And at the same time, we are absolutely militant on cost control. And you can see that white line on the top, that's the operating expenses line. Those are our overheads. That includes marketing, our staff, our server costs, rent, all those sorts of things. And you can see that even as we've grown very, very rapidly, again, more than doubling in revenue last year, we've actually brought those operating expenses down through really disciplined cost control. And so we now have tremendous operational leverage in the business. We have 30 staff onshore here in Australia and some offshore contractors. And we're currently issuing between 30 and 40,000 of these advances every single week. So there's tremendous leverage built into the model. That headcount has been very, very flat over the last couple of years. So we're very pleased with how we're going on that front. If you go to the next slide, you'll see, and all of these slides go up and to the right. And so I won't spend too much time on any of them, but you can see here the growth in advances, very, very strong. 6 halves ago, we did $20 million. Last half, we did $324 million. That average advance size is increasing as well. We've gotten a lot more experience and capability and built a lot of IP around how we do limit setting. We're very pleased with all of that. And then if you go to the slide after that, you'll then see the progress in active user growth. As of June 30, we had 234,000 active users, so up 35% year on year and kind of up very significantly over the 3 years that are really the life of the business. We've been around for 4 years as a company, 3 years in the market with the product, and a little over a year and a half as a public company. If you then proceed to the next slide, you can see the improvements in credit quality. In the early days, as we were building out our risk models and collecting the data to build those, we had relatively high defaults, and you can see that has come right down over the past several halves. In the most recent half, we had net default rate of 2% and 2.1% for the year. The slide after that looks at the funding costs. So because we are a business that does rely on external financing, we are a lending business. People often worry about our exposure to interest rates. What often surprises people is because of the very short duration of the book, we actually have much lower sensitivity to funding costs than you might expect. This looks at the cost of our facilities and then the loan to value ratio on our duration. And you can see that we charge that 5% figure that I talked about, and about 2/3 of 1% covers those funding costs. And even if you were to see those rates rise in terms of what we pay for our debt, the impact is not that material. Each 1% increase in interest rate costs increases that funding cost by 0.06%. If you turn now to the next slide, you'll see the direct service costs. These are the variable costs per loan. Again, very tightly managed. With that 5% that we charge, we in FY23, about 0.3% of the amount advanced covered those variable costs per loan. And then finally, if we move on to the next slide, you'll see that our balance sheet looks like. It is a very strong balance sheet. As I said, no head company debt, more than $20 million in cash, and again, a relatively small lending book. So because of that short duration, the business is not nearly as capital intensive as a lending business that's writing longer dated personal loans or mortgage or auto finance or anything like that. So a really small and relatively easy to fund balance sheet. So if you turn to the next slide, that's where we stand today. We put this slide in every pack just to help people understand how to think about the path to profitability and how to model the business. at a very high level, we look at pay advances per month. That's obviously a volume figure times a margin figure, net transaction margin. Those things multiplied together have to be greater than our monthly operating expenses. And the next slide, again, I won't go into this in any detail, but the next slide lays out each of the numbers half on half that you need to model out that business. We don't put out forecasts, but a lot of people look at that and draw their own conclusions about that progress towards profitability. And if you think back to that slide of those two lines converging, I think we've demonstrated that we are in good shape there. In fact, we exited the year in Q4, we were EBITDA positive. So we feel very comfortable about our momentum there. Then finally, the last slide of the pack talks about where we are now and where we go next. We have been relentlessly focused on grinding away towards profitability. We've kept costs dead flat while working on the unit economics, and we will continue to do that. We've still been growing very strongly, and obviously we will look to continue to grow. We are very focused on just this relentless optimization, do everything 1% better, as frequently as you can. That's really been the core to us getting to where we are today. And then finally, as we turn the corner towards profitability, and we are, as you look at our results, you can see that we have made tremendous strides there and are pretty close on that. We are starting to also look at, in addition to the growth we have in the core business, are there additional things we should be doing as well? So in short, I think the business is performing well. We have very rapid growth, very pleased with our cost control, very pleased with our unit economics, very pleased with our balance sheet, and we feel pretty comfortable about where we're headed for the future. So I'll pause there for questions.
Yeah, I've got plenty of questions for you, Jamie. And look, for a business that's only been up going for 4 years, very impressive growth in that time. And that's where I'm going to start the questioning. You touched on this just a few minutes ago that you recently reported that in Q4 23, you're EBITDA positive for the first time. How is the EBITDA tracking for this quarter, and how confident are you that you can continue to deliver positive EBITDA going forward?
So I'd say that this quarter is trading is broadly where you might expect it to be. We haven't released any trading update within this quarter, so I don't have much more to say on this actual quarter. What I would say in terms of if you look over the course of the year, there is some seasonality in the business. So Q1 tends to have lower growth and better credit outcomes because of tax refund season. Q2 is the opposite because of the holiday season. So any individual quarter will always bounce around a little bit. I think in terms of the fundamental economics of the business and the trend as to where we're going, I think that's been a pretty clear one-way trend, and we feel confident that we're still well positioned for the future there.
Good to hear. There's a question here. What percentage of applicants get through the initial screening process?
Yeah, so we have fairly tight eligibility criteria, both in terms of protecting ourselves commercially. So we need to see things like a steady income that comes in regularly that we can see and feel comfortable lending against. We also have some values-driven criteria around how you use your money. We want to make sure that we are advancing money to you that will be used to put you in a better position. And so, for example, we have bright line eligibility requirements around gambling, around other debts, and so on. What we tend to find is that depending on kind of where exactly you measure in the process, as we said in the prospectus, roughly 20% of users fall through on those eligibility criteria as of that date. And then we will turn down some others where they may pass the eligibility criteria, but we just don't feel comfortable that we can lend them in a commercially sensible way. We try to say yes as much as we can, so that turn down portion of eligible customers is actually quite small. But what we do that's really important is we will vary the limits quite significantly. So you don't apply for a certain amount. We look at your data and we approve a certain limit, and you can take an advance anywhere up to that limit. And for some people, that limit might be $50. And for some people, that limit might be $2,000. That enables us to dollar weight the book very significantly to the less risky customers who are most likely to pay us back. So we think from an economic standpoint, we're less focused on those customers who are getting the $50 and $100 loans. They're not that material to the book overall. From a value standpoint, we try to give people a go where we can. And if you show good repayment behavior, you may see that limit increase over time.
Got you. And what is the status of pay advances so far this financial year, and what growth are you seeing?
Yeah, so I'd say that, again, we haven't put out any kind of intra-quarter trading update. We'll put out our first quarter results at the end of October, on October 30th. Broadly speaking, as I said, with seasonality in our business, we see that Q1 tends to be a slower growth quarter, and it tends to have better default outcomes. And again, that is mostly because people are getting their tax refunds, so there's less demand for the product, and at the same time, a greater ability to repay. And then what we expect is that Q2 tends to be a busier quarter. There's more usage, there's more growth as people head into that holiday season. And we see the flip side on the risk outcomes, which is that we tend to see higher defaults as well. More broadly, structurally, we still think there is tremendous runway for this business. When we look at the number of Australians who could qualify for a product, they're employed, but who also say, I live paycheck to paycheck, or sometimes I couldn't raise a certain amount of money in an emergency. That's a very large group of people. And I think where we are today in terms of our active user base, in terms of our registered user base, we think there are many more people in Australia who could benefit from what we're doing.
Got you. And how is your customer acquisition cost looking? And can you continue to lower this number going forward?
Yeah. So in FY22, our customer acquisition cost was $105. We're a tremendously analytically driven company. So everything we do is tracked and measured, and we experiment and we test and refine. And starting in the middle of last year, we started to turn that analytic kind of capability and horsepower towards that acquisition engine. And as a result, we drove down that acquisition cost from $105 in FY22 to $42 in FY23. I've consistently said in every quarterly webinar that we do that I think the cost base, I think this is as low as it's going to get, and we can't do any better. I've been wrong every single time. We have continued to bring costs down, decrease CAC. Having said that, this time, seventh time is the charm. I think actually our costs are about as low as they can get. We are running a really lean organization, so I'm not sure CAC would decline much further from here. We're very comfortable with a $42 CAC when we look at the value of our customers and the experience we have, that loyalty and reuse. That's a very sustainable number for us.
All right, just a couple more here. And what is the current average pay advance size, and how do you see this evolving in the future?
So the average pay advance in FY23 was $366. The way that we set the limits, which is obviously the biggest driver of that pay advance size, is we look at a customer's likelihood of being able to repay at different amounts that we might advance them as a limit. So we would look at you and say, what's your probability of default for a $300 advance, for a $400 advance, for a $500 advance? And then we will set a limit that both is consistent with your income and ability to repay, and also commercially we think makes the most sense for us in terms of the value of this advance, revenue less defaults, as well as your lifetime value, and we look at migration through different risk scores and so on. What that means is, in practice, we don't target a certain average advance size. What we do is we use that optimization in order to get the right amount, and then it turns out that whatever that amount might be is really a function of the mix of users that we have in terms of what we're seeing in the economy, in terms of the quality of our risk engines and how they improve over time. Historically, we've seen that gently rise over time, which is both due to the fact that our customer base is becoming more affluent. Our average customer, we most recently published a figure, has a pre-tax income around $60,000, which compares to the median Australian income of $63,000. So our customers are becoming more affluent, and the risk engines are just getting smarter. We consistently upgrade and optimize them. They get more data, which makes them better. And that enables us, again, to differentiate those limits more and put more safely in the hands of our less risky customers. So I would expect that, all else being equal, that would probably continue to rise gently, but we don't target anything. We simply let that optimization algorithm work its way through and give us the best values for those customers, which could be up or down depending on a variety of factors.
Fantastic. Now, Jane, that's all we've got time for. Really appreciate you coming on today, and we'll be keeping a close eye, and we'll get you back on at the end of the year. All the best.
Thank you so much. Thanks, everybody.